All right, guys, thanks for jumping on. Let me run through a couple slides and then we'll get Jeff up here to go through his deck on sort of where we are right now on the multifamily side. Um, we'll go through a little bit of an intro for Old Capital, give you a few comments on recent deals that we just closed, and then we'll get into Jeff stuff. And then anybody who wants to hang out at the end, we'll stop the recording and we can just answer any questions at that point. Okay, so Old Capital, we're a mortgage broker.
Oh, you're
Someone muted me. Okay, so
yeah, you're back.
I'm back. Okay, sorry about that. Okay, so Old Capital, we're based here in Dallas. Last year we did close to 300 million in multifamily loans all across the US, but majority of it here in Texas. So we're gonna have Jeff talk nationally, but then also bring it into Texas. Here's a couple of the deals, Class A deals across Fannie, Freddie. We did some smaller deals, Freddie SBL, bank loans all throughout the nation. Um, I do not know what. Okay, this thing is going crazy on me. All right. Okay, in terms of other stuff that you can follow us here, Old Capital Podcast, we've been doing for 10 plus years. You can follow us on YouTube. Julie does her Zoom at 8. You can also meet with her. She does that on Tuesdays, I believe. Um, and then some of the upcoming events that we are having in person, that let's see, in 2 weeks, March 27th, we'll rent a bus and go see some of these lovely properties. So we usually start at maybe your Class C deal and then work our way up to B and then an A deal, um, all here in DFW. So if you haven't registered for that, that's in about 2 weeks. And then our big event is going to be in September this year, September 23rd and 24th. This will be our 10th annual conference. We'll have probably about three or 400 investors from across the nation who will be in town for that event. Um, let me see if here's a picture from last year's event. We've used a pretty good crowd out there. But I did want to touch on just sort of what we're seeing in the market right now, in terms of, let's see. All right. I keep getting these notifications. Okay.
Mhm.
This is one of my favorite slides, just seeing where we're seeing rates across the board right now. Um, Recently just closed a bank loan that we're going to talk about, right around 6.25 to 7%, just depending on, how big of a lift it is and the size of the transaction. A lot of Freddie Mac, SBL still getting closed, but that's probably in the sixes right now, about 6 to 6.75. The Freddie Mac and Fannie Mae right here in the middle, we're seeing more of that at sort of the low fives, the 5.75, depending if you do a buy down and how long the term is. And then a lot of non-recourse bridge loans are still in that 6.5 to 8% range. Um, Usually SOFR plus three is usually where those deals are starting. The larger deals, you're probably SOFR plus 250, but the smaller deals, SOFR 350 to 4% is where we're seeing those price out to. Here's a couple deals that we recently closed. This was the deal in Grand Prairie, 57 units that Ricardo had worked on. That was a bank loan. This was a Freddie Mac SBL loan over in Richardson that we just closed. This was a deal, Fannie Mae loan over in Irving. So wide range of different asset types, A, B, and C that we are closing nowadays. Um, oh, and then here's a non-recourse bridge that we did close at the end of last year, sort of taking someone from a floating rate loan into a fixed rate bridge loan here in Irving. So I think that was it on my side. Let me see, Jeff,
Mhm.
if you want to jump in here
Okay.
let me make you um, the host, or maybe I'll stop sharing
Well,
and
I
maybe
think,
you can put your sharing
yeah.
on. Yeah.
Okay. I think I can, and I think I will.
Okay. So,
Okay.
all right, there you go.
All right. Good? All right. So great to see everybody. I'm going to start over here. Um, James sent me the list of a couple of things that people are interested in, and let's make sure that we cover those today. Um, Interest rates and financing, rent growth and demand, property values, and guys including that cap rates. Uh, Distress and other buying opportunities, kind of where those might be and what they are, and then some notion of new supply and absorption. So I think we'll be able to cover honestly all of those things. I'll try to do that in a sort of expeditious fashion, but I'll let James interrupt me whenever he feels like it to ask me a question, and or we'll catch them at the end. However, so I'm going to kind of cover just what I always do to give you my perspective of the summary answers, and then I'm going to walk you through kind of how I got there in terms of the of our overall economic context, housing affordability issues writ large, and kind of from a longer term perspective, population migration patterns, and then we're going to get into multifamily performance forecasts, and then some generic investment strategies around which we can have a good conversation. Kind of about, and I hopefully, and through all of this, we'll cover everything that was on your mind. Okay. So, just kind of from an opening perspective, in my view, right, and again, we need to sort of take out the sort of momentary sort of headlines. So a year ago, it was Liberation Day and the tariffs. In fact, I remember, James, a year ago, we actually had a similar webinar on, I think, April 2nd, and people were freaking out. And I kind of said, take it easy. It'll all be cool. It'll all come out in the wash. So now it's almost not quite a year later, and we got a war in Iran, and I'm going to say the same thing. Take it easy, be cool. It's all going to come out in the wash. Um, some short-term pain, I think some long-term gain. And then when I kind of view it as last year, the official statistics are very, very bumpy, and you really need to see. I look at read-through statistics that tell me that the economy grew around 2% last year, and I think it will accelerate to around 2.5% starting in the late spring as some of the tax benefits begin to kick in terms of the overall policy mix. Remember, the Trump fiscal policy is a mixture of policies, some disinflationary, some inflationary, some pro-growth, some anti-growth, and there's a constant sort of balancing of those levers. And so, right again, then you have to see the whole field. And so I'll go over it. But again, writ large, I still think we're in a good, by and large, in a pretty decent shape. Now, from an interest rate perspective, I believe that we'll see 2 to 3 short-term rate cuts at the back end of the year, getting the 10-year at the end of the, excuse me, getting the short-term rates at the end of the year down to three-ish, let's put it that way. But the long rate, I think, is bouncing between 4 and 4.5. It was as low as 4. Today it's 4.25. It might go up a little bit more, but it's in that range. And then if you're talking about 150 basis points for a Freddie loan on top of that, there's your mortgage rate, pretty much. Okay. And then you can take that 3 and then put a floating rate a margin on that in terms of how do you get your debt rates. I don't think, even though one could, again, you have the push and pull of the labor markets squishy, but you also have oil, which is kind of going the other way. Um, again, you have to read through housing, which has basically been the long pole in the tent. But the bottom line, from my perspective, is that inflation is in this 2.5 to 3% range. You may get up a little bit, 3.1, 3.2, because of the oil shock over the next month or so, but it'll drop down. The CPI we saw in January and February was around 2.5%. Core was around 2.5%. So you're bouncing in that 2.5%. And a key component of that is that housing, which is something like 40% of the CPI and something like 35% of the PCE, which is what the Fed uses, is housing. And housing costs, as measured, around 3%. They've come down from 4. What's the main driver of that? Renewal rents. What's the main driver of renewal rents? High housing prices. What's the driver of that? High interest rates. So you're actually in a do loop here. So again, anyone who's actually reading through this basically says inflation, if you take housing out, it's around 2% ish. Bottom line, that's why it supports getting to a short-term rate of around 3. Okay. Labor markets are structurally tight, but they are near-term softening compared to what they were. Absolutely the case. Now, the good news is AI-driven productivity is at 2.5% is a big deal and an economic stabilizer. It's supporting Real wage growth at 3.5, 3.7, inflation at 2.5-ish. You're talking about real income growth at around 1%, again, before this sort of oil shock. Labor conditions are really squishy. Okay. Healthcare has basically, in social services, has been pretty much all the growth since interest rates went up. You strip that out, you pretty much have flat job growth everywhere else, which is 86% of the economy, which is why people are so cranky. You also had restatements of job growth in 24 and 25, which kind of reinforced this, I'll call it like slowing labor market. It squares with consumer sentiment. And again, part of this is with immigration policy settled, and that is much lower. We're basically losing people. We're not getting people, and we're losing people. So that the break-even job formation number is really quite low, 50,000 a month, if that. And so again, you're kind of in a low fire world that's kind of squishy here and there, where you've got productivity enhancements. You have enough fear in the labor market that people aren't sort of, dropping their hat and running away and going to get a higher rate job. But there's productivity of people who have a job, a little bit of squishiness of people who would like to enter the market. So but again, historically at 4.3% unemployment rate, that's amazingly tight if you look at in historical perspective. 4.3 is about the same as it was in 2019, which was the same as it was in 1969. And again, from 1969 to 2019, unemployment had never hit 4% on a sustained basis. So to a certain extent, our heads are all kind of whacked in terms of what our expectations have become. Now, there is a new policy mix which has emerged where you've got deregulation, tax cuts, and what had been lower energy prices that counterbalance trade frictions, which are driven by national security policy, first and foremost, and labor cost pressures, basically to reduce immigration and increase lower income wages, which hasn't quite worked out as much as one would hope. But those are the inflationary parts. The part that I would continue to highlight to everyone is the large federal deficits at now 5% of GDP are unresolved. They require faster growth. Eventually, they're going to have to require reduced spending and selective tax increases. And the thing that I usually go at to every time with an older audience is that anyone who earns over $200,000, in my view, will never get Social Security, ever. It doesn't work. It's not financeable. And in 2032, it's going to get taken away. That's how I'm actually managing my own personal financial planning. So I would highly encourage you to be the same, which is why you kind of need to be in hard assets. That helps a lot. And again, the treasury yields, bouncing in this 4.5% range. I would highly also urge, if you ever have the chance, read two of Ray Dalio's most recent books, How Countries Go Broke and How to Deal with a Changing World Order. Best economic history I've ever read, and I've read a lot. He's amazing. Okay, he likes China too much, but if you kind of blow past his love of China, you kind of get to a lot of real interesting insights. The Chinese are way screwed up. If you want to understand how badly, you can read Peter Zion's book on global powers. Okay, enough of that. When we switch over to the multifamily market, okay, the multifamily people got amazingly rich in multifamily over the past 6, 7 years. Okay. We're now in I mind, a notion of resiliency. Okay. We've had decent demand, which absorbed an ahistoric sort of supply wave, particularly in the Sun Belt and the Mountain West. And when I mean Mountain West, I mean Phoenix, Salt Lake, Denver, Boise, kind of that strip of up the mountains. Our view is that high home ownership costs have been supporting rental demand, and we see this in lower turnover, in rent increases on renewals, and that has been supporting property financials even as rents to new leases have been weak, except for the Midwest and Northeast, and maybe you got San Francisco, which has finally recovered. Okay, and so our view on rent growth is nationally, 0.5% this year on new leases, up 1-ish% 27, 2% in 28, and then you kind of get to 3-ish% in 29. You do normalize back. Now, big regional variances though, depending upon the trajectory of supply absorption. Again, really different. The Midwest is 30 to 40% increase since COVID and growing 3-ish%. The Sun Belt is absorbing that new supply. However, it's also rebuilding its affordability for another leg up in terms of population growth. Okay, at least on a relative basis. And we've seen this. I've seen this back to 1970. This is just that in the Sun Belt, this is a really big upcycle and now a really big response. But this actually is a functioning market compared to the coasts, where you've got a lot of regulation and enforced shortage and eventual rent control. So, you know, that's just dealing with that level of volatility also creates opportunity. And that's where we'll also kind of discuss that. So migration has kind of slowed down. Texas, Florida, the Carolinas, actually even the Midwest are actually kind of gaining. There's a couple of continued losers. Political pressure for rent control or rent regulation is a wild card, and not to be sort of particularly in blue cities in blue states. And we're seeing this again. It's an aftershock of what happened. Completions and new supply peaked in 24, is stepping down, and we're kind of get to a level of around 450,000 units in 26, 27 and beyond. Understand 100,000 of those are affordable and SFR BTR. So if you're looking at pure multifamily, you're at about 350. Okay. And 350 is kind of what things were. I'll call it some level of pre-COVID-ish. Okay. So you're back to normalization. Okay. And you don't have a ton of single family new supply. So the structural notion of shortage, the structural housing shortage really once this passes, has really not been resolved. Now there's some attempts. The Senate just passed a big bill. The House passed a big bill. They're trying to do things. Certain states are trying to do things, but understanding the political risk environment in each one of these states is a big deal, because even if they want housing, some states are just uncomfortable with the people who make money from it. So if you go to California, go to New York, you go to Illinois, yeah, they might want the housing, they might encourage it, but you have to navigate the fact that they really don't like the people making the money doing it. Not that it's not possible. I just talked yesterday to someone who's doing that, but it takes a certain tolerance for risk. Okay. Again, so we are seeing this kind of level out. There is a structural housing shortage. I don't think it resolves. And so what I see is overall nationally, 26 and 27 is, if you use it pejoratively, muddling through. I also could turn that to be opportunistic. And what I mean by opportunistic is in places where there's a lot of supply, construction loans coming due, deals that were bought at the peak of the market will present stressed and distress opportunities. And we will seeing more of those resolve. And I think we'll see more of those resolve through the year, because people have been hoping for a long time that somehow the market would just kind of bounce back and would save everybody, and it's just not happening. We're also seeing people doing a lot of work with nuanced tax situations. There's also a list of, let's say, those HFC deals that'll blow up in 2027. We have a list of those. We know who they are and what they will be. Those are, I'll call it special opportunities. There are opportunities to basically get tax incentives for taking on some affordability requirements in a appropriate way, and that works too. So you got to basically find distress, find a tax special situation, find something special that makes deals happen. But I would also say these kinds of situations are also where people who are willing to sort of find those niches do quite well. And so that's my overall shtick. And now let me show you how I got there. James, I see this quizzical face on your quizzical look on your face. So I want to
So,
give you an opportunity to hit me up.
yeah, so it's all right, so talking about special situations
Yes.
and where people can attack some of these deals. I mean, a lot of the questions we got were around, I want to buy the deal,
Hmm.
but the lender's not willing to take a discount on it. And if I don't see rent growth right now, how do I make it work? Right? Because they still feel like the basis. So even if they
Still
get
too
it for the
high.
loan amount, it's
It's
still
still
too
too
high
high.
for them. And so they're pushing back on the broker saying, well, I can't, I still
Well,
can't buy it.
in those situations, I would be
Yeah.
looking for some sort of tax advantage. I don't
Okay.
think the lenders are of a mood to take a write down. They don't care about wiping out the equity.
Yeah.
Okay, that's not a
Okay.
problem. But
Okay.
the lenders are not willing to take a write down on multifamily. They're mostly saving their loan loss provision for office assets. because they
Okay.
know they got to take the write down on those. So they're trying to at least come out whole on the multifamily deals. So they haven't had enough pain where they're willing to take a write down. Now, if they get a year's worth of carrying costs on a bad loan, that usually is the pain that will motivate them. But if they're inside the first year of carrying costs, they probably think they can get their price. And so they might, right? They might. And then there's a risk that they won't. So if the bank is balking right now, and again, I'm looking at the banks, the debt funds, the life insurance companies, folks who are outside of the securitized world, the GSE, Freddie K certificates, that kind of thing, because that has a process you have to run through. But that's where the opportunities are. Um, Certainly to wipe out the equity, and the lender is probably not feeling enough pain in terms of carrying cost if they just took it back. They might have to have a year's worth of pain before they say, ah, crap, the carrying cost here is going to cost me X. I just want out. And I think in Dallas and in other markets, 26 is going to be rough. 27 is not going to come to anyone's saving grace until I would say the late third quarter of 27 when things kind of start to turn around. So you kind of have, how much pain can somebody take before the deal works? That's what I would tell you.
Okay. I
Okay.
want you to go through your slides, but
All right.
the all
But
the
I
way
always
to
find it's fun to have the answer now, right? You're not wondering what is Jeff going to say, right? You know exactly what I'm going to say. So now you can sort of like listen for how did I get there, if you agree or disagree, which is fine, and what other questions you want to ask me. Fair enough?
okay, to me that rent growth question is the number one question for me
And
is
we will
how you
get
guys.
and
Okay.
by golly, we'll get there.
All
Okay.
right, you
So
guys have to hold on.
you're gonna have to hold on. So
All
first
right.
of all, just understand again, as you look at the sort of the global side of things, we have a tug of war between deglobalization and AI policy. AI policy is a pro-growth, right? Productivity. Deglobalization basically is inflationary and disruptive. And so those are pluses and minuses. I think there's more pluses than minuses. That we have an aging population with declining birth rates. Slow to no population growth, absent immigration, which is going to recede, and therefore structurally tight labor markets. Okay, and therefore picking jurisdictions and cultures that are pro growth is going to be a big deal. We still have COVID aftershocks. There's still more hybrid work and more remote work than there was. And the government took on a lot of debt. And so now we have longer term interest rates because that debt has got to be resolved in some way. I think in my mind, we will have some sort of financial repression akin to the 1946 to 1952 um, collaboration between the Treasury and the Federal Reserve to suppress interest rates below inflation. So being a saver in sort of cash will not be a wonderful thing because the government will basically inflate you away. So we also have a housing shortage. Again, we'll pass through this wave. There's an attempt to resolve it. We also know, and I see single family home prices coming down in the Sun Belt. And so the combination of income growth, uh, price declines, and stabilization of rates, affordability gradually improving. But remember, you can't have a collapse in the home market without a banking crisis. So you can't have a big collapse. You got to have small little collapses. Or if you're having a collapse, it's got to be localized. You can't have a national collapse. And a political polarization is a real thing. And how a local jurisdiction responds to shortage. Does it enable abundance? Does it allocate shortage? Tells you a lot. Okay. My overall perspective here is that from a GDP standpoint, we're going to be 2 to 2.5%. That the GDP deflator is running, from again high twos down to 2.5. Again, you may have a little bounce around because this Iranian thing, this war, but I think it passes in 45 days. It won't go to the Congress, and Congress has within 60 days of a conflict, the president has to go for the war powers. So it's a 2 month deal. And you look at the administration, they say it's 4 to 6 weeks. Guess what? 4 to 6 weeks was within the 60-day window. So it's got to end at that point. But frankly, the Iranians are hoping they can outlast 2 months of bombing to survive that period of time. So everybody knows what the clock is. The question is whether they can make it or not. Unemployment, I think, is bouncing around 4.25. The bond yield, I think, is again bouncing 4.25 to 4.5, and short-term rates coming down at the back end of the year down to 3. So that's kind of my view on that stuff. Yes, have tariffs had an impact? Yeah, they have to a certain extent. It's true. Is it a huge impact? Not really. Again, when you post it against other things. So this is just a notion of like, yes, did it have an impact, a 2% index on imported and domestic retail goods? But that's not the whole economy. So it's a thing. It's not the end of the world. Okay. Now, the point one I would make here is that when you look at GDP, housing is the long pole in the tent. The construction of the CPI component of housing is designed to underrate it when it goes up a lot and to overrate it when it comes down. And this was a response to the 1970s, where they only looked at new leases. They changed the construction to primarily focus on renewals. And so in 21 and 22, every economist was screaming at the Federal Reserve that the real inflation rate was 15%, not 9. Okay, not 9. It never was 9. It was 15. Conversely, we're really at 2-ish%, not 3 nationally. Okay. So anyone who knows what they're doing, and look, the people at the Federal Reserve are not dumb. Okay. They kind of know that the real rate is kind of 2-ish. Okay. And that's why rates were kind of coming down. And I think they'll continue to come down the second half of the year. Uh, Also, it's understand that most of the consumption going on is being driven at the upper end of the economy. This is a classic, can go back to the GFC, then go back to COVID. What you have when you have these kind of issues is you have kind of a depression. You throw out the money, and remember, inflation is not just goods and services; it's also assets. Assets inflate faster than goods and services. And so, in fact, that's why consumption is primarily driven by the upper end. And again, if you look at wage growth, and right now it's not at the lower end of the economic scale. It's at the upper end, though they did have their moment in 21 and 22, but it was still below inflation. Okay. So they had real, even though it was higher relatively, it was still negative. Okay. And even this was probably not true for higher income Americans, because higher income Americans have less, and we'll get this in a second. They probably didn't buy a new home. They probably didn't buy a new car for a while, and less of their consumption is food, energy, or housing. So we do have a top-heavy economy. Again, I like to look at this CPI by income bracket. And again, if I did this on a cumulative basis, lower income Americans have been exposed to a higher inflation rate than the overall on a cumulative basis. And what this also means is that the sort of the crankiness of lower income Americans, both in 24 at the election and 24 and even now, is valid. It's absolutely true. It's absolutely there. We also see it in some of the delinquency data that's starting to kind of come through. And it's not for people not working, first of all. So the 25 to 54-year-olds are back into the labor force at a higher rate than they were pre-COVID. The shortage of labor is driven by older Americans who are leaving the labor force, and they are a growing percentage of the population. That's the issue that's driving the structural tightness of the labor force, which requires AI productivity to sustain overall growth in national income. So it's not the problem; it's actually the solution. Okay. Though all these things always come with some period of disruption. Now, again, if you look at employment by industry, and you kind of see pretty much it's healthcare and social assistance, which bless people's hearts, they're not really wealth generating sectors of society, right? So the wealth generating sectors of society have been roughly flat, not entirely, but roughly flat. Again, which is why most of the people in the economy are cranky, right? So if inflation's been there, you're top heavy a little bit on spending, you haven't seen a lot of job growth. Your wage growth isn't bad, 3.5%, 3.4, but you're kind of cranky. Okay. That's what we're seeing. Okay. Now, and this is just an example of looking at information technology, right? Where the company, again, if you own the stocks, you're on a tear. If you're an employee, they're basically renormalizing to the hiring binge that they had in 21 and 22. Pretty much what's going on. Okay. And you also see this last little bit here, college graduates who are entering the market with no real skills. They're the ones who are taking it on the chin when it comes to hiring, which isn't the greatest thing for our world because they're not forming maybe households at the same rate as they had been. They may have to double up to make things work. Um, and that's because if you're a firm that used to hire 5 analysts, you probably with AI could get along with 4, right? And that's quite a savings. Again, you blow that out across the entire economy and all the information work, that's where you tend to get this little bit of a problem. Not a surprise, not the end of the world, but you know, not a surprise, which means that kids will need to upskill themselves into AI skills in order to sort of crack into the labor force. And by the way, we're seeing that as well. I will tell you, some of the best AI skills people in the country are actually not in the country. I have a team in Romania that is crushing it, far better than Americans in their AI skills. Anyway, so unemployment rate and occupational rate also kind of slightly skewed higher. This is the issue that needs resolution. All right. So from 1946 to 1970, the debt to GDP ratio went from 120 down to 30 because of financial repression and growth in the economy. We had multiple sort of economic just issues where the monetary policy fled debt, and now we're at a point where it has to be reined in. Can't be Has to be resolved. All right, now let's move on. So we'll go through this very quickly. We just haven't built enough housing. That's period. That's what it comes down to. It's not rocket science. Now, when we look at single family housing, I do think we'll see corrections in Texas and in Tampa. I think actually higher than this, more like the 6 to 8% range. This is where we're kind of seeing it. Um, and I actually happened to look at an app called Reventure, which does a great job of repurposing single family housing data. So when I'm looking at multifamily housing, I'm also looking at the single family housing at the same time. And these things actually rhyme. They basically line up together. You're seeing again, in the Sun Belt and in Texas and Florida, home prices are declining. And in the Northeast and Midwest, they're still going up, lines up with what's happening with multifamily and the supply picture as well. Not rocket science. This is just something I do. Yes, there's undersupply of housing, even in Texas and Florida. This is what's been driving fundamentals for multifamily. Okay. Even as rents went up 20, 30% and have leveled out because new supply hit. The cost of owning a single family home has shot up because you had a lot of movement of people from high areas to low cost areas. Supply doesn't respond in housing super quickly, right? The rates went up at the same time. So this gap is what's been making multifamily work. Okay, absolutely. There's no at the upper end, and we are seeing some loosening of that as people have mortgages that fewer and fewer of them are kind of under 4%. Now it's 50%. It used to be 60%, as the market gradually does loosen. Okay, and then other part to note, home costs are also have to take into account escrow. And taxes and insurance have become a greater and higher percentage of the total mortgage payment than they used to be. So that's not, in Florida and Texas, again, non-trivial. Texas, both taxes and insurance. Florida, mostly insurance. Other places as well. So that's another piece of it. Yes, it fits into that metric we had on total mortgage payments, but as you're looking at the own versus rent spread, it's a meaningful percentage, not just looking at the sort of principal and interest payment as well. Now, something to sort of take in as we look at this, we looked at, for properties that we call renter by necessity, that's your B and C class assets. If you basically take the cumulative increase in rents back to '07, pre-GFC, and you roll that thing forward, the cumulative rent increase that lower income Americans have been exposed to is far in excess as to higher income Americans, and higher than an AMI growth. That's the dotted line there. And higher, of course, higher than the average. So again, the pain that lower income Americans are feeling is real. They get hit it from housing and gas and food. They are exposed to those sectors that have grown in price higher than the average, and more of their income is spent on those. So again, the strain on lower income Americans is a real thing. Okay. We also see it in rent to income ratios, which have risen from a COVID level to now about 4%. So essentially, that's real purchasing power erosion of about 4%. Now, and it does vary by city. to a greater or lesser degree. Some cities, and again, I look at the renter by necessity rent to income ratios. Anything over 30 is tended to be sort of a little too high. And you will see, some places that you wouldn't expect, like Chattanooga or Lubbock. These are places that like you would think they'd be, you know, low cost to live, and that's not necessarily the case. They're also low incomes as well. Okay. And we have all this data. James has it all. Um, so by market. And now I won't go over that, but this is just affordables rising as a percent of stock. I won't go over this one. This is just, yes, there's problems with rent control. All right. So let's just talk about, the growth in the population has slowed. And again, it's kind of slowed, I'll call it the pre-COVID levels. And then you've also got a decline in international immigration as a result of policy. You had also had in the prior years a massive wave, an increase, which strained housing markets and social structures and everything else we're talking about. But I would say Texas, North Carolina, Florida are still growing, are still beneficiaries of that migration trend, but at a slower pace. But remember also, housing, completions are also at a lower pace. So things are sort of all coming in kind of together. And I think that's important to understand that spread. And then state to state migration is kind of back to pre-COVID levels. Okay. And we see this here, this massive peak, a historic peak in terms of population growth and international immigration, and then kind of back down to a level. But also, if you note the natural population growth, right? That's something to really be keep mindful of, because this is what's really going on with the people in the country. Okay, which is an aging of the population, a getting married late, having fewer kids, having them later, all of that reducing the natural growth of population. State to state migration levels kind of back to pre-COVID levels, and then yes, the Southeast Florida, the Southeast Texas have been the beneficiaries of international migration. This is U-Haul data. It's nice to always take a look at that. You can find some interesting things there. This is just for the 24-25 period of population growth that came out. If I'd rolled this back to 27, it'd be the same states, just higher numbers. Like Texas would be 7% versus 1% for the past year. So you saw a big number in COVID, but the direction of travel is still the same. New York, California, Illinois, still sort of barely hanging on a losing population. Texas, Florida, the Carolinas still growing, Utah growing, Arizona growing less, Idaho growing well, Colorado, my home state, not growing because of public policies becoming more California-like. So, the bottom line, blue policy eventually kills everything. So be mindful of you guys in Texas. Don't let that happen to you. And then we also do our population forecasts. And this just says, we do expect the Sun Belt to continue to grow. We absolutely expect that. This is over the next 5 years, right? We expect population to continue to grow, which will absorb the units that are there, which will continue to grow economic growth. And again, and the political structure of these business-friendly cities will continue to generate economic dynamism. We also look at the infrastructure investment, and James has a whole grid that we'll go through shortly that looks at infrastructure investment in all these cities. Okay, so now let's actually get into the meat of the matter here. Okay, so this is typical, and on a national basis, we see a rent by necessity, again, that B-class asset rents grow faster at the back end of a cycle than the front of the cycle as new supply begins to move in. This is a super cycle here, big up, big down, and we see this exact same pattern. And the February numbers just came out, very akin to January numbers, which is you're seeing a seasonal uptick, but a sort of modest one, again, with a big regional spread. And there's your 21-22 kind of big ahistoric movement in rents. Okay. If you look at this is expert data, which is actually from the property management aggregated anonymized data. You see this big run up in new, and now it's kind of bouncing around to one. You also see the renewals that went up slower. And then are still growing. And then on a cumulative basis, kind of this collapse of the loss to lease, and they're sitting around top. In fact, if you're at the very, very end, you can see that new renewal rents are actually higher on balance than new rents. And that, my friend, hasn't happened, I think, in my 30 years in apartments. Apartments are acting more like self-storage facilities in that regard than they ever have. And again, if you look at this, this is new leases, new lease activity. You can see definitely the regional component. And this stuff on the right is just pure supply. There's a lot of supply hitting. It's got to get absorbed. Rents are going down. It just is what it is. And then you're seeing it on the other end. The Northeast, Midwest, and San Francisco are having their moment. Occupancy is kind of recovered. Absorption, I do want to get to is there's always the fourth quarter is always the weakest quarter. It was a little weaker this quarter than most. Okay. And I can even give you the DFW kind of numbers on this one. But you also kind of saw the completed units were also down. So less units, but also fewer absorbed. So kind of again, there is a little bit of weakness in the fourth quarter numbers, and I won't go over this, but the tertiary markets, some of them are doing quite well. They didn't have a lot of supply; they have a little bit of overflow, and they're doing okay. One thing I do want to highlight here is this is data coming from our expert data from the accounting system, and this is just the spread between new two bedroom versus one bedrooms, and it's just a measure of hey, is two bedrooms outperforming one bedrooms? That's kind of it, and you'll see in many of the markets, in fact, two bedrooms are outperforming because of the cost of homes being so high. And only in a few markets are you seeing one bedrooms actually like here outperform two bedrooms, but they're both losing ground on new business. Denver and Austin looking pretty ugly there. Now, also on the renewals, again, you're looking for our two bedrooms performing better than one bedrooms. In some markets they are, but not in every market. There you go. There's Dallas, where again, one bedroom on renewals are actually doing better. This is the key thing that I really want to lock into is that renewals are performing much better than new business, much better. Okay. And more of the units are actually renewals. So on average, pre-COVID, I'd say in the Metroplex as an example, average turnover would be 55%. Now it's 40. So that 15% of units that aren't turning, not only are they aren't turning, they're paying higher rents. And that's really driven by high home prices, an aging population of renters who don't want to move, and the stickiness of moving, the transition cost is higher than just paying a little extra, and then life goes on. You don't have that kind of disruption, and so that's a big deal. Ones as well as two bedrooms. You're seeing the same thing, right? Renewal lease trade outs, and these are paired lease transactions, much better on renewals than they are on new business. So this is a key thing as to if someone says, why aren't I seeing more distress than I otherwise would have expected to have seen? This is why. This is absolutely why. So a lot of owners that bought at the peak, while they're under pain and they're under stress, they've been able to hang on longer than they otherwise would have. Now, on the other hand, if a property owner lets the capex go so badly that they get a run of renewals that leave, they are decimated because they're going to have to pay to turn those units, and the new leases they're going to get slaughtered. So professional managers are absolutely doing everything they possibly can to keep heads in beds, to not turn over units, to do whatever it takes not to basically allow people to leave if they can do anything about it, because the penalty for a move out is severe, right? You got the probably 4 to 6 weeks of a vacancy. You got your turn costs are 2 to 3 thousand. Plus, when you do get somebody in there, they're going to pay you less. That is a punishing number. And we are seeing in certain places 1 or 2 month concessions on among new properties in terms of new lease ups. So that's another 16% cut. So it's brutal. New leasing is brutal. All right. So are there fewer units in lease up? Absolutely. Absolutely. And this is our view of rent growth, which is kind of modest. I think occupancy hangs together, but nationally rent growth is kind of modest. This is our view on completions. And you can note the gray and that light blue, that's partially fully affordable. So if you look just on market rent in 26, 27, right, you're kind of back to, kind of pre-COVID levels. So to the extent that there's more supply in there, it's in the affordable range. Now, I will tell you, affordable in Texas is basically being priced to be exactly competitive with market rate properties. In fact, if you look at the tax credit deals, which we do a ton of data on, the tax credit deals at 60% of AMI are basically probably above what market rents are running in certainly in Austin and right in there in Dallas. So the new affordable deals, which are designed for compliance and not for customer service, they're getting killed and actually are a source of demand for market rate properties. And in Austin, as an example, it's actually the spread is about three to 4 points of occupancy. So affordable properties in Austin are at 87% occupied, and the market rates are at 91. They're basically drawing customers out of affordable housing, and affordable housing is taking the hit. And so again, that's another reason why some of these properties have been able to hang in there longer. This is just starts, which basically is 2 years ahead of deliveries. No big deal there. This is just a notion of our view when you look at a 5-year run rate of new supply. Dallas has a big pipeline, but 2.3% over the 5-year period of time in terms of expansion of stock, totally absorbable. Not that big a deal. Now, it's just a little front end loaded, okay? But as we look to 26 I'll show you this. Last couple years in Dallas, you were living 40,000 units. Going forward to 26 to 28, in total, it'll be about 20 in total. That's North Dallas, suburban Dallas, and Fort Worth, the entire Metroplex. Now, it's not nothing, but it's not like as big as it was. And you see this across, all of these markets. These are not crazy numbers over a 5-year period of time. Okay. So now one of the things, this is to kind of highlight this. We've got if you look at some of these high supply markets, of course, Dallas and Houston are in the middle of that. They're not super high supply on a relative basis. Okay. They're kind of in that middle bunch. So if we just take these kind of dozen or so very high supply markets as a percent of stock, and you look at the rent forecasts, 26 and 27 look like, kind of rough years before things nettle out in 28. But when you blend in the renewals, right? And this is a projection, not really a forecast. The blow is cushioned, and that was the point I was trying to make here. Okay, because the renewals actually sort of support overall positive revenue growth, and expense growth has come down quite a bit as well. Okay, so you can eke out in many cases financials aren't sort of deteriorating from an operations standpoint. It's more the ones that have been strained as the strain continues. Okay. And then we kind of look at this in terms of rent growth and which markets are doing
Okay,
well,
Jeff,
and that sort of thing. Yes.
this is my go back to that slide.
Well,
So this is
it's not, that isn't quite what I wanted to kind of show on 26, because what I
okay.
really want to show, okay, so let me kind of go to something else that I really want to kind of highlight for you guys.
Okay.
Um, we just updated, I need to get this bar out of my way. If you look at our forecast, and this I'll go here first. If you look at our forecast for the Metroplex, okay, this was updated in February. You can kind of see that, yeah, again, this is what happened last year. You can kind of see, yeah, Fort Worth, right, Dallas, and really that 4.3 is driven by the northern part of Dallas, which has a lot of new supply hitting. So it really depends upon which area you're talking about. And furthermore, if I went over here, there's a big spread by submarket, like really big. Okay. So there are submarkets in the Metroplex which actually look really good. Okay. Really good. And there are some that are really, really bad. So remember, there's 143 submarkets in the Metroplex in our analysis. So it's a lot to choose from. And there are pieces that are forecast to do well because they have good demand drivers and they don't have a lot of supply. So I'm going to want to emphasize, right, when I give you a number, right, that 4.3 was kind of driven by, hey, well, Fort Worth, again, look at the highest priced markets are the ones doing the worst because that's where the A class assets are kind of coming in and pushing down pricing all down the entire spectrum. Now, I do think we have begun to see some impact in Class C assets of a drain in as international migrants have left a lot of these cities. They mostly left the informal sector. They were never really in the professionally managed sector, even the 50 or 100 unit properties. They were in the 10, 20 unit kind of informal sector. But as they've left the informal sector, that's loosened up other people, who maybe have been in the formal sector to sort of look for a better deal in the informal sector. So you are seeing some squishiness, on the Class C assets. I would say Class B in the middle of the stack there are the most insulated from those, new supply at the upper end, immigration sort of receding at the lower end, where Class B is right there in the middle, with decent product, kind of a customer base that isn't, either super high end, super low end. They're actually doing pretty well. So that's what I wanted to. So I don't want you to fixate on that one, James. Okay.
Well, what the reason when I went through the deck, if you go back to
Yeah. To that, you want me to go back to that now?
yeah, just real quick. I just want to
Okay.
so so the negative 4.3, you're
Yeah.
saying that's an average for
That's an
Dallas.
average. And I showed you the
By
dispersion.
submarket, it could
Right,
be
right,
yeah, it could
right,
be doing good.
exactly. It's a very important, right? And remember, I'm giving a talk to people who are national investors,
Yes.
who are tend to be institutional investors, who are looking for broad strokes. So I'm saying,
Yes.
yeah, broad strokes, that's true,
So I
right?
think what threw me off was the 27 number.
Yeah, yeah. And I know let's go and take a look at that 27 number. All right. And so, yeah, you look at this 27 number, it's still -2, -5, -6, right? And so
Okay.
look at the trajectory here. It kind of goes down and it eventually comes back up. All right. But it may take a little while for that to happen.
Yeah. Okay.
Okay. And so the important thing to kind of understand. So again, you want to look at, what's your year-over-year change? Kind of goes down, comes back up, right? It's still negative before it starts turning, right? It becomes less negative, but it's still negative. So I like to look at these graphs to kind of tell me the trajectory of it, particularly on a modeling perspective as you model this out. But I would say is you want to make sure that you are in your acquisition modeling that you can ride this out.
Right. Okay.
Okay. You can,
So
so
this is based
it's
off
just,
of absorption of new supply. Is that how
yeah,
you're getting? Okay.
it's basically how much new supply is still coming and what that absorption kind of looks like. And therefore, and also obviously job formation and household formation. We have a whole bunch of stuff that kind of goes into this, into the hopper here. But this is kind of where we're coming out. All right. But my view on this is, um, we have been pretty right. Okay. Uh, we haven't necessarily been the most popular people, when I went, but we've been right. And my responsibility is to give you accurate information so you can act on accurate information and not act on inaccurate information, which you then come back and tell me, Jeff, how come you hurt me so bad, right? Um, Now we don't try to be overly conservative. We just try to get it right. Okay. And we were within 100 basis points of getting it right. Um, Last year, the year before. So our forecasts have been within about 100 basis points, of reality. And in my view on that, that's pretty good given the uncertainty of the world.
Right.
Okay.
Right.
Right. And so you should also make sure that you have a sensitivity analysis around your rental growth assumptions that, if things went 50 basis points either way, that you could still sort of write it out.
Right. Okay.
Right. Okay. So that would be my perspective, which is why I brought these things up. And also, I'm glad I had these other sort of items here. But I would also tell you is, sales volume and values, are still going up in the Midwest and somewhat Northeast. And yes, values are coming in. So yes, I would say, and the real wall of maturities is 28 and 29. But I do think fundamentals will be in better shape in 28 and 29. Okay. So it's mostly, in my mind, folks in 28 and 29 who really bought at the peak. So if you're looking for stress and you're really focused on stress, you're either going to focus on construction loans that are coming due, or you're going to focus on people who bought at the peak. Again, I have a very specific sort of set of criteria. You bought at the peak, you bought it with variable rate debt. It was probably from a debt fund or a private lender, and you've been in a market where fundamentals have been declining. You put that collection of conditions together. There's several thousand around the country that fit that. And remember, there's 120, 125,000 properties. We're talking about maybe 5 to 6,000 nationally that fit this box, and not all of those will go bad. Okay. Somebody might come up with some capital. They might not let it go. So you're talking about, you know, what is it? a few percentage points of the total stock, 3 to 5%. I view that as a trickle of blood, not a river of blood. Okay. Yes, there are opportunities. Yes, they are out there. But yes, they're selective.
So, Jeff, even though it's a trickle of blood, the problem is that all eyes are on that blood.
I hear you. I hear
So,
you.
I mean,
I hear you.
I think that's so what we're seeing is people are like buyers in the market. Let's say there's 40 deals on the market in DFW. They see that blood on 5 deals. That's all
Right.
they can focus on. It's
Well, here's
hard
what
to,
I would tell
yeah,
you is, and I would, I think you are empowered with could be as a great power user of a Yardi matrix. We can help people identify the deals most likely to go bad. I can't
right.
guarantee you which one, but we can tell you which ones are likely to go bad. So the idea is to get in front of those lenders, get in front of those owners early, begin the conversation, be used to them saying no, 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 no. It's always a no until it's a yes. Okay. So the bottom line is it's going to be a no until they have no other alternative.
Right. Yeah.
Right. And then if you're hanging around the net, again, and that's why you have to have, if you're going to pursue this kind of strategy, you're going to have enough balls in the air so that you're waiting for the one or two to drop. Okay. Because I can't tell you and you can't know of the 20 that are available, which two are going to actually transact. But you
So
know
the
that these 20 are all probably having trouble. And I'm using 20 loosely. Again, it's in depending on like a big market, it's several hundred. And I know in around the country it's several thousand.
right. Right. Okay.
Okay. All right. So we'll see how much time we have for the balance of this. We have some data. And by the way, James can send you these slides. It's not a rocket science here or a big secret. We also do some expense data here. And again, I would say expenses have absolutely come in 1.6% growth year over year. It's not that bad. It was 3% the year before. It was 5, it was 7. So again, expenses have come in. And it vary. Now, this is the point where we talked about strategies, and we've kind of been doing this all along. No city is perfect. Cities all have some problems. It's just understanding what those would be. And when I look at this kind of on a sort of strategy basis, this is where I kind of get to and talk about, hey, look, and I'll leave. This is probably the last slide we'll kind of go into. Um, you have recovery of the core markets. There's some conversions going on. There's a lot of political risk in these markets. Often you play that using affordable housing. The Sun Belt are great cities, and I would say understanding that Houston and Dallas are not as heavily supplied as the Austins or San Antonios or as the Charlottes and Nashvilles. And their performance has been actually, Houston's actually performed pretty decently in this entire period of time. Kind of flew under the radar screen, believe it or not. Like most people just forgot Houston existed. It's the fourth largest city in the United States, and it's been kind of ignored in the cycle. Okay. It's got the benefit of some decent oil production. It's got some medical. It's not a bad place, but you got to pick your shots carefully. Um, and these other markets are mostly again distressed plays. There is a group of Midwestern cities that are emerging, just like the Sun Belt emerged 10, 15 years ago, and are intriguing if you're willing to basically do some advanced legwork. Okay. But I find some of these markets quite intriguing and interesting, and they are developing, and there's not a lot of supply there, and there's some good things happening there. So I would just kind of highlight that to you. I won't spend a whole lot of time. We have slides on each one of those pieces, which I don't think I'll go into at this point. Um, but since most of you guys are sort of focused on the Sun Belt, understand like this is how much stock in these high markets has already been delivered. Okay. And which is humongous. And this is how much has still yet to come. Okay. So there's still more in Miami coming. Again, you're not going to see Dallas here because Dallas is kind of in that middle range. Okay. So if I want to go specifically to Dallas, because I know James loves to see that, um, basically, this is the completions trend for the Metroplex, right? You kind of, and if I go, right, so the high is 40-ish thousand units. Before then, it was running 30. Before then, it was running kind of 20s. Okay. And if you recall in this range, you were having good, I'll call it 3% rent growth in the Metroplex. It was just kind of clicking along 2, 3% rent growth. It was pretty decent. Okay. And now when I go to, again, looking at absorption over the past years, was really good in 21. And, there's been a lot of supply added, okay, over the last years, which has eroded occupancy levels. And if I go to where the forecast kind of is on a go forward basis, this is the Metroplex. Okay. If you look at that, you're looking at 25,000, 22,000 units, about 20, Ben, you're into the 20s. Okay. And as a percent of stock, that's not bad. About 2.5% of stock. Not bad. Okay. Not bad at all. Okay. And I also have Fort Worth here. Where is that? Fort Worth, again, a little higher. But again, once you get past 26, 2.5, 2% of stock. So the conditions for normalization, okay, are sort of coming into play here. Okay. And this is all multifamily, not just the market rate deals. Okay. That's everything. Again, I could look at the market rate deals and it's a little bit less. Okay. So again, if I look at Dallas and here, you're talking about 12,000 and if with Fort Worth, another six. So you got 18,000 market rate units, right? Not the, whatever the 24,000 I was talking about, because some of those are affordable. Bottom line is, uh, I kind of see a return to normalcy over the next couple of years. So if you acknowledge the fact that 26 and 27 is sort of a recovery phase in terms of like there's still units absorbing, you know, there's modest migration, there's is increasing economic growth that's moving up, it'll absorb it. Like things are moving in the right direction. There's a window here to take um, advantage of stress situations that I think will create some tremendous opportunities in some of the out years. Okay. But if you're going to deal now, you just need to understand you got to ride out this short period of time. This 26, 27 is going to be a little on the rocky side for housing. I think the economy will pick up. And that's important because the economy needs to pick up to create the economic growth, the wealth, the income, right? In order to sort of get the markets moving forward. So that's my story, James.
That's the
Okay.
story. Well,
That's the story. I hope
I
I bounced around some, but the idea was to sort of give you enough of a view of things. We also do some great work on affordable housing and where submarkets are expensive, relatively speaking, and some areas that might be protected. And so all of that stuff is inside of what James does for you guys. But I will stop sharing and answer
so
any questions you might have.
okay, Jeff, I'm gonna hit you with three questions and then I'll let
Okay.
you go. All
All
right.
right.
First question is not really a question,
Okay.
but AI
Yes.
feels like it has taken over the world already. But what's your 2 cents for multifamily investors?
Um, so first let's talk about AI relative to employment, and then we'll talk about AI relative to sort of operations and that sort of thing. Um, it is a major opportunity to improve generalized productivity. Okay. And in any technology that the US has gone through, and it's one of our sort of superpowers, quite frankly, as an economy, is that we innovate the technology and we have a flexible enough labor force and labor market that we actually can install that technology and achieve productivity increases. I think it's going to be disruptive for a period of time, as all new technologies and general technologies are. But if you see where it's adding the most, it has eliminated some very low end jobs. You cannot call an inbound call center and find a human being anymore. That is just not happening, right? Bottom line is the turnover at inbound call centers was like 90%. They had hellish time staffing these damn things.
Right.
Okay. So there are some jobs that have just gone away, but even the people who held them didn't like them, to be honest. Okay. Uh, Other jobs are being enhanced in terms of their productivity. And those people who are basically using AI as a companion to their productivity are going to be more valuable. They're going to get paid more. It's going to be a good thing. People who are new entrants to the marketplace on using, I'll call it information processing are going to have to upskill. Now, on the other hand, we need a lot of plumbers. We need a lot of electricians. We need a lot of people who work with their hands who have technical skills. And so you are seeing and already have seen a shift of what careers are more valuable. Okay. More towards hands-on work. Anyone in the oil field business. Hey, that ain't the finding the oil may be AI, but getting it out is still quite manual, right? Housing construction, housing repair is still incredibly unproductive as a sector of society, right? It has achieved no productivity growth in 50 to 60 years. So maintaining physical structures. So I do see a reorientation, which, by the way, was already going on pre-AI. This is just accelerating that trend. Um, so for people who have repetitive information processing tasks, yeah, that's going away, right? If you're executing a repetitive information process task, right? Moving a number from one thing to another thing, yeah, that's probably going to go away.
Okay.
That's
And
true.
then second question, you've
Yes.
touched on it already in terms of the whole war in Iran.
Yes.
And the oil, like every time I wake up, oil's either 100 or
Yes.
120 or
Yes.
80.
Or
And
80 or bouncing
yeah,
around. Yeah. So,
yeah.
so look, the way I view this and the way I think you should view this is um, there's there's two maps that are going on here simultaneously. There's a regional map and a global map. The Israelis are involved in the regional map. The US is involved in the global map. Iran matters because it is a piece, it is one of China's pawns. And it was also being used for Russia, and Russia is one of China's pawns. All of this leads back to the geopolitical competition between the US and China, and the US and Trump has been at this now for at least 10, 11 years, probably 20 years. He is trying to box out China. Okay. He's going to go see Jing. They're going to make nice and they hate each other. And they know they hate each other. And they know they're in a global competition. And the whole idea is he's going to go in and say, I took your damn chess piece off the goddamn board. Okay. You're going to try we can blockade you at the Strait of Malacca. You are screwed 7 ways till Sunday. You screw around, you try to do anything, we're going to take you out. So you got to understand, like, well, some people will say, oh, Trump's not that smart. He is a straight up gangster from Queens. He's like my crazy Uncle Murray, who's as crazy as a fox. Do not underestimate this guy. Also, understand that the people around him are not dumb. I went to school with some of them. They are really goddamn smart. Marco Rubio is definitely had a role to play in Venezuela and Cuba, right? So Venezuela was another chess piece taken off the board. All right. So again, the Israelis want regime change. Trump basically wants to neuter them. Whether he doesn't care whether the Iranians are free or not, he could give a crap. But he wants to control over the resources and the foreign policy. He doesn't care what goes on with the domestic policy. If the regime would basically say uncle and say we'll repress the crap out of our own people, but we'll play nice outside, he'd let them go. But they won't and they can't, and the Israelis want to push this thing over the edge. And there will be a point in time where the goals of the United States and Israel diverge, and I could honestly see the U.S. stopping and the Israelis keep going. Okay, now at the end of the day, this will eventually bring oil prices down. Eventually, because it'll basically take China's discount because the Iranians have been selling to China oil at a discount. The Venezuelans were doing the same thing. So he's basically saying, I'm not going to allow you to have subsidized oil from Venezuela and Iran. So I'm going to stick it to you there. And I'm also going to stick it to your availability to get at it. And you're going to have to buy our stuff, which means you're going to pay us instead of us paying you. Like, I know where this is going. It's just got to take time to work through. And if he was going to do it, he had to do it now because the midterms are coming up and he loses his room for maneuverability. So again, that's why this tariff thing had to start a year ago. That's why the tax bill had to be done last summer. That's why this thing has to happen. It's also going to eventually box out the Russians. Okay. So again, you're not done yet. So I know this is like, like a bit sort of esoteric stuff, but if you've got to understand the global play that's going on here. You've got to think 1930s. Okay. This is a repeat of the 30s. I just hope it doesn't end in the same way. Okay.
Right. Yeah.
But the economic forces, the debt cycles, what's happened since the GFC is playing out. Again, if you read Ray Dalio's books, he'll lay out the map for you. Okay. Um, None of this is surprising. Like, no, I've not been surprised at all. The COVID was a shock. Okay. That was a monkey, that was a sort of fly in the ointment. But the process of what has been going on geopolitically and deglobalization, I could see back from 2015 on. And I've been talking about it for 10 years too. Anyway, James, last question.
Last one.
All right.
So
Hit me up.
I okay. So you guys cover BTR
We do.
and you talk to a lot of institutional guys, and
We do.
I think this was passed today. I haven't
Yeah, it
read it
was.
all. So
It's not good.
yeah, what yeah,
It's
what
not good.
happens to all these
This isn't
BTR
good.
deals that are
It's not good. So one of the like the industry is continuing to try now that it's going to try and solve the issue in conference. Okay. And the fallback will be to sort of write provisions, that I know what was being proposed is like, hey, if it's on a single lot, that doesn't count. If it's multi-lotted, platted for single ownership,
yeah,
okay, fine. So it's going to be an attempt to sort of rewrite not the headline,
yeah. The
but the
headline
effect.
needs to be the same,
The
but yeah,
headline is unfortunately that
that's
that
gone. It's
that's
done.
gone. Yeah, that's done, right? Uh, and again, it's great headlines, bad policy, right?
Yeah,
Um, at this point, it's going to be trying to carve out the SFR BTR new supply to say, look, you want new supply. Otherwise, it's not going to get done. You think that land will be used for single family homes. It's unclear that it will.
right.
Okay. Unless somebody has in their mind that they'd rather have nothing than SFR BTR, right? Because they think that the land where an SFR BTR deal would go could be used for single family homes, or they think that the value of the land will be driven down low enough that single family homes will kind of make sense. It's Look, I've been around the SFR BTR space. I've always viewed it as a nice wedge, a supplement
Yeah, in
between
between. Yeah,
people who needed the room, people who wanted the lifestyle of a near home, but didn't have the down pay, right?
yep, yep.
They had the income, but they didn't have the down pay, and they wanted some element of flexibility. Um, so I think, and what we track is about, I think it's about 400,000 units in about
Right.
3,000 projects all around the country. Not huge. I mean, again, multifamily is 25 million units, right? Single family is 130 million. It's really, really small. Okay. But it's been a nice wedge, a nice compliment, which is why it's being thrown under the bus because it's not big enough that anyone
To
really gives a
defend
crap.
itself, it can't defend
It's
itself.
it's not big enough to defend itself against people who are looking for a convenient scapegoat. And it's going to lead, if you own more than 350 homes. Now, the real question I have is that in an LLC? So I could fix that. How do they determine who owns more than 350 homes?
Right.
LLC, corporate ownership? Are they going to pierce the LLC? Is it a holding company? I haven't read the legislation to the point to actually understand whether how you would actually enforce the 350 home number.
Well, I saw the 350 home number, but then it was also you've got to sell it to somebody within 7 years as a single family. You've got to break it up.
Right. And so to break it up, well, to break it up to a natural person, to break it up to another LLC, I could have 5,000 LLCs.
Yeah.
Every home is now an LLC. Like, understand like how dumb this is. Okay. Because remember, according to law, a corporation is a person under law. It's a corporate entity. A corporation is considered a person for legal purposes. So even if it passes in its current form, what's 350? Sell it to whom? An LLC that has single entity LLCs? I can do that all day long.
Right.
It's a little more of a pain in the neck. It creates more paperwork. It's a little more expensive, right? It's not ideal. Could it be done? Sure, it could be done.
But did with this proposal or even
Yeah. It's just not fun.
impact, did it just raise BTR cap rates by 50 basis points?
It certainly raised the costs. It now says it's created until the final legislation goes through and the lawyers get at it and find all the
Right.
loopholes. Yeah, right. Will transactions kind of like basically take a pause for a while, several months? Because now you got to like, okay, what are the new rules?
Right.
Okay, and how do we work around the new rules? What are they exactly? How do you define 350? What's a person to sell to? How do is it one lot? Well, if it's how do you define a single family home? Okay, if it's is it, I could say single family home is detached. Well, what if about they are attached? A lot of these SFR BTR deals are attached homes,
Right. Right.
right? In fact, many of them. I have a great organization, Redwood Living in the Midwest. All they build are ranch homes with a shared wall. Is that a home?
Or
Is
is it
it
an
a single
apartment?
family home?
Yeah. Or is it
I
multi,
could
right?
argue, no, it's not. It's actually a duplex. Townhomes, are they single family homes or not? I don't know. Maybe they are, maybe they're not, right? Think about like the stupidity, okay, of what this is. It's a headline because once I actually get at it, I'm going to find every damn loophole
Right.
of what's a single family home. Define it for me. Is it attached? Is it attached? Is it upper and lower? And I'm going to work my way around it. Okay. What's 350? How do you define that? Who's the seller? Can you distinguish between a single entity and a natural person? How do you know? The whole thing is going to like spin out of control, right?
Okay,
So
all right,
it's just,
well, Jeff, I thank you
so
very
there.
much for coming on.
My pleasure.
Um,
I'm glad we had a little fun with that too.
well, that's why I wanted to throw those out there because I know
Yeah.
those are moving targets a little bit right now.
Yes.
But
Yes.
we greatly appreciate you coming on
My
and
pleasure.
sharing everything with us, and we'll send out the slides and everything. So, and I will see you in Vegas next year.
All right. Take
All
care,
right,
everybody. I hope
all right,
this was helpful to you. You take care now. Bye bye now.
all right. Thanks, Jeff.